Okay, so after all of that, I'm going to now show you the results, all right? So this is the cumulative performance of three groups of companies. Pharma companies identified the way that I just described. That's from 1930 all the way to 2015. That's the cumulative growth of a $1 investment. The yellow line is the tech sector. You know, this is MIT after all, so I got to look at tech. And this is how tech is done. Pharma's done better than tech. And then the green line is the S&P 500. So you can see that over many, many decades, the pharma industry has done really well. It's actually gone neck and neck with the tech industry, but overall, it looks like it's got less volatility, and in the end, it's actually done pretty well. Starting right around the 1990s, it was actually the same, but since then, you know, tech took a big dive with the tech bubble bursting. That affected the pharma companies a little bit. The financial crisis had a much bigger effect on tech than on pharma, and overall, pharma is winning. So that's one takeaway. The pharma industry is a good investment, but it does have some risk, and I'll show you in a minute. All right, now I'm going to show you biotech. And don't get upset. I'll explain in a minute what's going on. So the biotech industry started in 1980. And the red line is biotech. This is the cumulative performance of biotech. Now, before you get discouraged, I have to explain a few things about this, and it'll tell you something interesting about the industry as well as about these k-means classification methods. So the first point I want to make is these indexes are all value-weighted. Value-weighted means that they are weighted by market capitalization, so the bigger companies have higher weight. And so what you're seeing here is the performance of the biotech industry as weighted by market cap. But it turns out that this result depends very intimately on how 11 companies are categorized. And you can imagine, yes?
I think the good biotech companies became pharma companies.
Exactly, right, exactly. Now, so that's a question. How should we interpret that? Do we want to keep Genentech and Amgen and Gilead? Do we want to keep them as biotech companies? They don't look like biotech companies today. They did back in the 1990s, but not today. So now this brings up a very important issue, which is that when you classify this matters, right? In the same way that the Zen observation that you can never step into the same river twice, time is this flowing river, and depending on where you step into it, you're getting a different result. So this classification is as of 2015. So it's as of today. But of course, the seed portfolios, the seed companies in our dots, we're using them as whenever they're available. And over time, the value of these parameters can actually change. So let me show you what happens if instead of using our k-means classification system, instead of doing that, what if we used the GICS code or the NICE code? The thing about those classification schemes is that once they categorize something, they don't change it. So in other words, once you are given a classification as a biotech company, they don't go back and change your classification. That's what you are. Occasionally, if there are like mergers and acquisitions and you change your line of business, they might change it, but they don't really take into account growth. So these 11 companies, it turns out, have a big impact on the results. And they are classified as pharma companies, not as biotech. So, which makes sense because they're big, successful companies now. But they weren't back then. So here's the result. So this is the old result, right, with our k-means classification. This is the result if you use the GICS codes. And here's biotech right up there. And the red line is biotech, right? It's doing quite well. And if you look at the last 10 years, this is on a logarithmic scale. So the slope tells you the rate of return. Biotech is actually putting everybody to shame. It has got a much steeper slope than tech, S&P 500, or pharma. It's on a real tear. So, of course, this result is pretty heavily driven by like 3 companies. If you take out Amgen, Gilead, and Genentech, you don't get this. But remember, it's value weighted, so it's weighted by market cap. So given how big those companies are, they're really having a huge impact on performance. And so I'll get into the returns in a minute, but I just want to just illustrate to you that the results of how biotech has done really depends upon what you're trying to accomplish with these statistics. If you want to ask the question, how does the industry look right now and how does it compare over time, then using the K-means classification may make sense. But if what you're asking is a different question, which is what happens if over time you're an investor and investing in biotech, you may want to change the experiment a little bit. We actually tried to do that. So what we did was by hand, we said, okay, after the first 10 years, let's start Amgen as biotech, and then after that, let's call it pharma. If you change that, you actually don't improve the performance of biotech that much, because at some point, Biogen does become a pharma company, right? Just by definition of what we mean by a pharma company. So I would argue that this actually is not that bad a descriptor of what's happened in biotech. And it's because the biotech business model is not necessarily to make money in the traditional way. And so let me illustrate to you that fact. So here on this panel are the annual returns of pharma and biotech where I'm looking at the distribution. So each line represents a different percentile. So the yellow dotted line is the 75th percentile. The green solid line is the median return of all companies in that sector in that year. Okay, so it's year by year. So you can see that the annual returns of the pharma companies, the median return is generally above the black line of 0. And by the way, let me tell you what the scale is. The scale, these are stock returns, and 2, 4, 6, 8, 10 is not percentages. It's 200%, 400%. And the reason I had to do that is because in the 1960s, the pharma industry had an amazing year where there was a company that earned 1,000% return. So I don't know what that company is, but I'm going to be looking at that over the course of the next few weeks as we sift through the data. So this is the 95th percentile, this dotted line up here, and you can see that the pharma companies have done really well over time, which is why it sort of squashes everything else. But if you look at the median performance, and in a later version I'm going to blow it up so you can see it a little bit better, the green line is generally above 0. So that means the median pharma company generally earns a positive annual stock return, okay, in the data. The right-hand graph, let's take a look at biotech. The median biotech company is generally negative in its annual stock returns. Now, it doesn't mean that there aren't big outliers, although not as big as pharma. So notice that the scale is different. This goes up to 10. This scale goes up to 6. And there is a company in 1990 that did really well. But it doesn't have the same level of outsized performance. And on average, there is a greater part of the distribution that is 0 or less. Yeah.
Wouldn't that make sense, since the way we're defining biotech is that they largely don't have a commercial sales force?
Exactly.
Or anything like that.
Exactly.
They're
That's right.
Operating at a loss.
That's exactly right. They're operating at a loss. They're not trying to make a return necessarily. That's not the objective.
I'm curious too about how, would you consider a return if a pharma company bought a biotech company that's privately held? That could be incredibly lucrative for VC or whoever has funded that biotech.
That's right.
How is that taken into account?
Well, it's taken into account in the data in that the liquidating return is what the acquisition price was.
So is that factored in?
It is. It is factored in here. So companies that have disappeared because of acquisition, they would have had a spectacular return, and then they would leave the sample. So that's in there. Yeah. And to Susan's point, that's exactly what's going on, which is that biotech companies are not necessarily trying to make great returns year by year. They have no earnings in many cases. What they're trying to do is to get acquired. That's the business model, right? Keep that in mind, because that's going to have consequences. So I'll come back to that. So now let me take a look at profitability. This gets directly to your issue about what are they trying to do. So this is pharma profitability. I'm measuring profitability as earnings divided by assets. So it's just a ratio of the profitability of the company. And if you look at pharma profitability, the green line, again, is the median pharma company in that year, the profitability is generally positive. It's never, ever below zero. Pharma companies make money on the median, right? The 50th percentile. Obviously, there are bad pharma companies out there. We can see them here. But if you look at the median pharma company, they always make money. What about the median biotech company? The median biotech company, the 75th percentile biotech company loses money consistently because they're not trying to make money in that way. They're not trying to earn profits. They, in many cases, have no earnings. It's not the same business model. Different kind of company, all right? So that kind of explains the difference in the growth